Hey everybody, this is Jose. We are about to start 20 something seconds. So sound check, please, everybody. Type a quick message on the chat box if you hear my voice. That would be nice. So I know technology is on our side and we are ready to begin. Thank you so much, everybody. Wonderful. Thank you so much for confirming that. Very good. So basically, that's it. We just reached the starting time for the session. So we are officially live. This is the beginning of our get together session. I'm just going to turn on the video stream. How are you, everyone? Good to see you. Welcome to the session today. Today is May 7, 2020. We're getting together to do a little bit of trading, isn't it? Today, the plan is to look at longer term perspective in the marketplace. So we're going to be using options as we do every Thursday, normally Thursday. And we're going to be looking at both directional strategies as well as non-directional strategies and look for those opportunities that meet our rules. And if that's the case, we'll be ready to execute. And if it's not the case, patiently we'll move into the next opportunity, looking for those opportunities that religiously, impeccably, and with a lot of discipline meet our rules with no exceptions whatsoever. I see Ahmed with us today. How are you? Ahmed Rifki as well. How are you, Ruben? And also Abangs. Very good. Wonderful, everybody. Thanks for joining me today. I have a disclaimer to read, so I'll do this quickly, and that way we can begin the session. So disclaimers. The following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive on using our products. And this is the introduction for the session. The session is now officially introduced, so I'm going to close the PowerPoint presentation. I'm going to bring a TradeStation into the main screen. A little bit of trouble here, dragging my window. Here we go. And we are going to begin. You can see that I'm still running a scan here because I did run the scans before the market opened, but obviously the market has opened a little bit ago, an hour and a half ago, let's call it an hour and a half. And in that sense, new opportunities may have developed. So in order to have updated information, I am rerunning the scans, okay? So let me explain the scans that we have on the screen, okay? And that way, when we start utilizing them, we will be ready to go. So let me zoom in the right place. Here we go. This is the place where I need to zoom in. So what do we have? Okay, so we are looking at the bottom part of this table, okay? Everything else is Forex futures. It does not apply to today. So basically, we are focusing on those debit type of opportunities, DBT, or credit types of opportunities, okay? Those are two completely different ideas when it comes to entering the market, where the ones on the top means that we pay to enter the trade. So it's a debit. And that means that you need to catch a move and the move in your direction for you to end up with a profit. If you don't catch a move or the move is against you, you're going to lose. Okay, so in other words, this is what we call being directional. And with the scanner on the top, we'll be looking at directional long opportunities. You can see the up arrow. And the next scanner is going to be directional short. You can see the down arrow. So we'll be looking for opportunities to make money when the markets go up, as well as opportunities to make money when the markets go down. Okay, this is going to be the beginning part of the session for today, and this is the scanner I'm running, even though this is frozen. I froze my screen so I can zoom in. In the bottom part, we got credit opportunities, okay? And credit opportunities basically means, in an oversimplified manner, it means that you sell options, you collect premium, and then you let time pass until the expiration date takes place, and then the options expire, ideally worthless, so you keep the premium collected the day you sold them. Now, of course, this sounds to be too good true, isn't it? It's almost like you would make money all the time. Well, yes, you would make money all the time as long as, and this is the key, as long as the stock didn't move too much against you. And that's why we call these opportunities, which are either non-directional ND or neutral, okay, neutral, which means that basically you don't care much about where the stock is going. You basically care about the stock not going too much against you. Even though it's okay for the stock to go against you a little bit, it's fine, but not too much against you. That would be the neutral long and the neutral short. Neutral long means that you want it to go up, not to go down, and if it goes down a little bit, it's okay, but not too much. If you want it to go down, it means that you want it to go down. Going up, it's bad, but a little bit going up, it's okay. Too much, it's painful. Okay, and the non-directional, the pure non-directional, the ones here in the middle, those are the ones where you really want the stock to stay in a range, and basically you sell options above and below, and if it stays in the range at the on expiration date, you make money on both. Okay. So this is kind of a little bit of a summary of everything we got on the screen, especially for the ones of you that are new to the session, so you can follow as the session develops. Okay, so we got 96% there. So the scanner will be ready in just a minute. Okay, so we got directional long. The scanner is running here, 96%. Directional short, also 96%. So what I'll do is I will start with the non-directional trades, and then we'll come back to the directional trades to see if we have an opportunity or not. So what do we have? Well, when I run the scanner before the market open, an hour and a half ago, I got Baidu. Then I saw the gold ETF, and I'm gonna pass on this one because normally ETFs give you less premium, and when you do non-directional trades, it's a credit, so you want a lot of premium. So I mean, you could look into it, but normally it would be disappointing, and also the gold ETF has a lot of price decay, given the fact that the real gold trades in the futures markets. That's the ETF, so there is a lot of price decay. It's a bit tricky. Okay, if you apply AutoUFOs to GLD, out of curiosity, I just want you to see this. Okay, if you apply AutoUFOs to Baidu, for instance, okay, you'll get whatever number, 53%. Okay, if you apply AutoUFOs to GLD, be ready to see a much smaller number. Okay, GLD, 35%. Okay, even worse than stocks, and the reason why is because there is a lot of price decay, because gold trades 24 hours, I should say 23 hours a day, where the ETF is only 6 hours and a half, discounting pre and post market data. And again, so long story short, doing non-directional trades with ETFs is not the best. Okay, so basically we're gonna stay with Baidu, and also we have T-Mobile. Okay, but T-Mobile, I will have the tendency to pass on T-Mobile as well, because those are utility companies. Normally, they are stocks that the nature of those companies, okay, even though you can see a very strong move today, okay, but normally the nature of those companies, and you can see that clearly on the daily time from here, is that those companies tend to trade sideways all the time. In other words, because they are, let's call it a little bit of a boring stock, unless something crazy happens, like what's been happening in the markets, since the end of February. So unless something crazy happens, normally those stocks are very quiet, and that reflects on the premiums that we find on the options. So ETFs and companies such as T-Mobile, AT&T, you name it. So you get my point, isn't it? So normally are quite disappointing. So I'm gonna look at Baidu to see if we could do a non-directional trade on Baidu. This is gonna be our first attempt, okay? And I do need a requirement, okay, which at the moment is not looking too good, which I got 43% UFO performance stats. Again, we still have the PD here on the upper left. That means that data is still being downloaded, so pending data. So we need to wait until PD goes away and we see what that figure is. But we need that figure in a normal case to be 50% or above when we do directional trades. Okay, directional trades, we need 50% or more. For non-directional trades, okay, we need at least 48%, and now it's only giving us 43%. So initially you would say we cannot do a trade on Baidu because it's not good enough. Okay, now before I give up on Baidu, I got one last step, which is I want to check pre and post market, because many stocks will have their real strong, significant institutional interest placed in the pre or the post market sessions. So let's take a look at what's going on and notice how, in the case of Baidu, we got 49% with pre-post market. So in other words, with pre-post market, we may have something that could be tradable. Okay, with regular session is not the case. With pre-post market, maybe. Okay, so why am I saying maybe? Well, I'm saying maybe because there are more conditions for me to be able to execute this trade, isn't it? So I'm just going to get a trading view on the screen with Baidu. And why would I do that? Okay, well, because TradingView is going to be very, very nice at giving me the earnings dates. Okay, and earnings on Baidu happened actually yesterday. So, in other words, you know that options premium on TradeStation. We talked about that in prior sessions. Okay, I can show you this. Let me show you. It's going to be visual. So I'm moving back to the daily time from here, so I could enable a study called implied volatility stochastics. Okay, so I'm going to turn on implied volatility stochastics, which gives me a measurement of how expensive options are. Okay, and what's happening, okay, is that the reading that we have today, okay, it's placing the options prices to be at this level, 41%. It's not as high at that time because let's face it, that time was the end of February, beginning of March, when the world was ending, right? So, those levels of volatility are, I mean, it's not like it's the first time it happened for Baidu, but at the same time, there was a reason for that. That was not the earnings, okay? The earnings were basically bringing the value of options on Baidu around that level. Okay, and the problem is that yesterday they were at this level. TradeStation does not update until the next day. Okay, so basically this implied volatility information available on TradeStation is end of day data, and therefore when I run the scanner, the problem I get is that it's telling me 41 is the number. Okay, but normally based on experience, let's see what happens. Normally based on experience, if I look at the real time implied volatility, is going to be much lower. Okay, so to do that, I'm just going to load Option Station Pro. Okay, so I'm loading Option Station Pro. The moment Option Station Pro loads, I will then input Baidu in the option chain. We will load all the options available. And if you haven't noticed, you will see that TradeStation does show in the option chain the average implied volatility for all the strikes and all the expiration dates, and we're going to be able to get a real-time value, even though it's taking a long time to load, which is not a real normal thing, but I guess it's going to load in the end. It seems it's loading, yeah. Let me see if there are questions. Let me see. Gali, how are you? Ray, how are you? Ruben, Tastyworks says Baidu earnings May 18. Oh, interesting. Well, I don't have experience with Tastyworks, so I will not know which one of the two is going to be more reliable. I have been following TradingView since a few months now because I didn't used to use TradingView for that purpose, but I can tell that TradingView is quite accurate. So it'd be good to double check with another source of information. So I'll check Yahoo Finance in a minute to see what the right answer is. Okay. Okay, give me a second, guys. I'm having a little issue here reading the chat box. Okay. Okay, so I'm having a little problem here. I'm going to do a little reboot in one of my devices here, and I'll be able to read you. Okay, so anyway, I'm back to what I'm doing. Okay, so I'm gonna load Baidu. So Baidu, here we go. So Baidu is loading. Okay, I'm clicking the options chain. Here we go. Good. So this is the option chain for Baidu. Okay, and we can see here. Well, actually, it's actually a higher value. That's quite interesting. So notice that if we look at these values here, okay, basically all of them, 43, 56, all of them are greater than 41. Okay, this is something rare, I have to say. This is rare, unless what is really happening is what Ruben just said, which is the earnings date is actually happening on May 18, and therefore the price of the options is basically inflating as an anticipation for the annual report, for the earnings report, which is around the corner. So interesting. Okay, so I got May 6 for Baidu here. Okay, so let me do one thing. I'm gonna switch the data feed because I'm connected to TradeStation. So instead of using TradeStation, this is gonna be an interesting experiment. Okay, you guys see that I have here check mark TradeStation. You guys see that? So what I'm gonna do is I'm going to uncheck TradeStation. So instead of getting the Baidu data feed from TradeStation, I'm just gonna get it from TradingView directly. And if I do that, I mean, it seems to show the same. We got earnings to be May 6th. Okay, so yeah, so on that particular network, it's looking like the date is May 6th. Okay, but again, I got your point. So I'm gonna go ahead and look at another source of information, which is Yahoo Finance here. And certainly, I would say that probably Tastyworks is right in that particular case, given the fact that the implied volatility in the option chain is greater than what you see on the chart. I have never seen that the day after earnings on TradeStation. So that probably means, and here we go, we have now a double confirmation. Here actually it says May 19. Okay, so maybe we have a little bit of an anomaly, maybe because of coronavirus or something like that. There've been a couple of changes in a row when it comes to what the earning days will be for Baidu. So that creates a little bit of additional danger here. Okay, so long story short, we're gonna have to be very, very careful. And the first thing I need to do here is to bring a calendar, because today, okay, oh, sorry guys, I didn't mean to minimize TradeStation. So today is May 7, May 18 or 19 happens to be in that week. So in other words, we could use May 15 to plan on a trade. Okay, we could use May 15 to plan on a trade. Okay, but certainly not beyond that, because it's either 18 or 19. The good news is that both are happening after Friday 15. Okay, so let's see what is possible with Baidu. Okay, it does seem that in the end we may have a setup. Okay, but remember, we need to go back to the 55-minute time frame and also use pre and post market data to get this up to 49. Okay, so what do we have? Well, we have many red UFOs and not too many of the green. So if I look at the green UFOs, okay, I got two here. Remember, one of our rules is to use two, so 1 and 2. Okay, so that would allow me to sell the 94 and a half puts. But then if I look at 1 and 2, this is bringing me up all the way to 106.58. So my concern, okay, and normally I would use the option chain before I do anything else. But my concern, if I measure the vertical distance from current price to the purple line above, which is the purple line lining up with UFO number 2, and I was to project it below to have UFOs more or less at equal distance, notice how the next UFO is located very, very far away. So if I want to do something more or less equal distance, I need to point at that UFO, and I would love to do a trade using the 82 puts. I would really like that. Okay, but that's gonna bring my upper strikes very, very high, all the way to, let's call it the 113 mark. Okay, that UFO there, which is about 113. Okay, so the question is, well, great. Is it likely that Baidu is going to stay in that range between 82 and 113 from now until the next week, the next Friday, Friday 15? Well, visually speaking, I would say probably, even though we don't want to have that kind of approach to trading, we want to use statistics on the option chain, as I will do in a minute. But instead of putting time into this, I am concerned that the 113 may not provide enough premium. So what I'm going to do is the first thing is look at the 15 of May expiration, look at the 113. So I'm going to have to load many, many strikes, and it's not looking good, to be honest. If I look at the 113, well, notice how it's providing 6 cents. Okay, sorry, 9 cents. And that's not good enough. Okay, we have a rule that says that we want 35. In specific cases that are exception, we could accept 25, but our minimum is normally 35. And here is 9 cents, which is very, very, very far away from what we need. Okay, so no good, no good, but it doesn't mean you don't have a trade. So watch Baidu, guys. Tomorrow, Baidu may go up. Okay, and if Baidu puts itself more or less equal distance, okay, if this is tomorrow and Baidu is equal distance from that second UFO and that UFO, okay, so now because it went up, the 113 may pay you enough, and now you are equal distance, and you can rely on that green UFO that currently it's too close to the current price being here. But if the current price tomorrow goes up, then you may have a trade. Okay. So again, this is for you to watch for tomorrow, but certainly for today, this trade would not meet our rules. So I'm just gonna delete all the plotting and start fresh again. And T-Mobile, I'm just gonna skip it. Okay, because of what I said before, it would basically be wasted time. Okay, just like that. So I'm just gonna forget about it and go back to directional trades. And in parallel, I'm gonna run the scan. I'm gonna run a new scan because I run non-directional trades prior to the market opening. So I'm gonna rerun it to see if any opportunity appeared. Probably not, but sometimes one or two opportunities show up. So we'll take a look. And in the meantime, I'm gonna go back to directional. I'll start with directional longs and shorts and go through the list. Okay, so I'm gonna sort these based on price. Amazon is a fantastic stock to trade, to be honest. But so I would understand that many of you that are in the session today are in the session in learning stages and probably planning trades on a stock which is $2,300 per share. It's probably not ideal because it would force you basically to take the trade with paper money. You will not be able to execute with real capital because normally in learning stages you use either smaller accounts, or if you have a greater account, you use less of a position size, isn't it? So in this sense, we will pass on that. Thank you so much, Leland, for that. Thank you so much for that. Yeah, so it seems that I got my chat back working, so I can interact with you again, guys. It'd be great if you could just shoot a quick message, just all good or something like that would do, just for me to see that the chat is working well and I can interact with you. So I'll skip Amazon, I'll skip Chipotle Mexican Grill. I always say group is grill, and I'll start with Apple. Again. Nothing wrong with using the other stocks, but out of being a bit more adapted to what I would expect to be the right sides for a trade for a trader who is in learning stages. Okay, so what do we have with Apple? Well, while the intraday time frame is loading, really we don't need to look much more at Apple because we got 11 candles into a climate which, based on stats, is supposed to be 9. Okay, so we have surpassed what statistics suggest. Okay, and even though crazy could become crazier, well, when things are already crazy, and this is an oversimplification to probabilities, right? But you get my point. So when things are already outside what probability would suggest, really it puts you at a disadvantage. So because the US market has so many more stocks to trade, it is smarter to go ahead and look at other opportunities, such as UNH, which may be a candidate. So let me explain why I just said that. Wonderful. Thank you for the confirmation, guys. I can read you, so it's all good. So what do we have here? Okay, so we have a climate which has been currently developing for 3 candles. Okay, there are thick dots, so the climate is confirmed. It's blue, so it's up, and statistics suggest this climate should last for 6 candles. So 3 more days. Okay, 3 more candles going up. That would be a normal thing based on stats. So having said that, of course, we got more rules to meet to call this trade a valid trade. And one of the things that we need to find out is on-field orders. We need to find on-field orders around this price point, which is our reference. Okay, because you can see when price comes to our reference point with a good climate, okay, it bounces from that reference point. Not always. Sometimes it goes through. Okay, sometimes it goes through, but many times it does. Okay, and many times the reason why it does or it doesn't is because of the existence of on-field orders. Putting on the side the fact that stocks are a fragile instrument, and if the S&P was to crash, or the sector was to crash, or a close company that is a competitor stock or something like that was to crash, so probably UNH would be impacted by that. And many times stocks don't respect the technicals because of those reasons, because they depend on other external factors. And that's the beauty of using options, isn't it? Because we are not necessarily going to use stops. When we do debit strategies, whatever we pay for the debit is the most we can lose. and therefore, without using stops, it puts you in a position. It puts us in a position where the stock may go against us for a while, but then comes back and we are still in business. Okay, so that's pretty convenient. So what do we have here with UNH? We got good probabilities. Okay, unfortunately, that UFO at 273 is way too low compared to 288, so that would not qualify. So what I'm going to do, my last attempt here, would be to switch from pre-post market to regular session. I need 50% or more. Let's see what happens with UNH. Let's see where is the institutional interest. 52, that's good. And what do we have? We have a UFO here, and that UFO has the top of it located at 286, which unfortunately 286, it's, I mean, $2 full below 288. We could not say, it's lining up. Okay, would be a little bit making it up. Okay, so again, not an issue. We got more stocks on the list, so we're gonna go for the next one, which is AGN. Okay, and in that case, we have a climate which has been running for 11 candles, so no good. The next one is Microsoft. So let's see what's going on with Microsoft. Microsoft has been running for 6 candles. Statistics suggest 7. So Microsoft is a valid candidate. The question is, do we have UFOs around 178? That's the question. And it does look like we do. Okay, so we need to wait for the PD pending data to look at the probabilities to see if there is institutional interest or not. Believe it or not, sometimes amazing companies like Microsoft may have low institutional interest at the moment. Could happen. But it's not the case. We got 52% and we got UFOs lining up. So my friends, we have a trade to plan on Microsoft. I also want to check the pre and post market. 52 becomes 59, even better. And we also have that UFO there. So the top of this UFO is 179.19. Keep that number in mind, everybody. Okay, so I'm just gonna load it here. Microsoft MSFT. Okay, I'm gonna get into the analysis tab. And I'm gonna type, I need to type 2 values, my entry and my target. So 179.19. Okay, 179.19. So this is one of the values. But again, before I validate 179.19, I want to go back to regular session and look at those UFOs I had, because they are overlapping each other, isn't it? So I want to see which one is the highest one. Okay, so this one here on the top is located at 179.00. Okay, so I'm not going to use 179.00. I may miss the trade because of 19 cents. Okay, and because the UFO produced in the pre-post market session is somewhere here overlapping like that. Okay, kind of like this, 19 cents above, right? So I'm just going to use 179.19 as my entry price. Okay, so we have a climate, we have a UFO. So what about the target? Okay, so looking at the daily time frame of Microsoft, turning on auto UFOs. So do we have a target? Okay, well, Microsoft is, as we speak, inside of a UFO. So what is the rule when this situation happens? Well, the rule when that situation happens is ignore that UFO, because in an up climate, sell on-field orders tend to be canceled, while buy on-field orders tend to be added. And all of this together with the fact that the price is inside the UFO already for 3 days, that means that many of those on-field orders already have been filled for 3 days, during a period of 3 days already. And therefore, the expected quantity of on-field orders should not be that great. You can see as well the red color of the UFO is not dark, is light, even though this is not part of the rule. This is just an additional comment. And therefore, all of this tells us to ignore that UFO for the target. Okay, so where are we at? Okay, because when you look at the monthly time frame of Microsoft, probably most of you know that that stock is making all-time high. Okay, so what does that mean? It means that no matter the time frame, there is no other red UFO above this UFO. So what does that mean? That means that Microsoft is a stock that could be ready to have a breakout to the upside and begin again making all times high and resume and continue doing what he's been doing for many times. Okay, for sure, there is a whole fundamental situation out there in the world with coronavirus, everything else. But the technicals, the on-field orders, the climate, and everything else is telling us this is the case. So again, you could have a biased opinion about a one-time situation that is happening in the history of humankind, or you can just follow a trading methodology and make money with it in a mechanical approach. And that's exactly what we're gonna do. Okay, so we're just gonna go ahead and plan a trade on Microsoft, even though, given the situation of the markets, given as well the company we are talking about, which is Microsoft, which is a company which is extremely strong, fundamentally speaking. So here, basically, we have an opportunity to do two things, which is number one, take a trade just following the daily time frame and do what I just explained, or number two, go ahead and if you guys recall, let me bring it to the screen. So if you guys recall, okay, I getting back into our YouTube channel. You guys may remember sharpening sessions, view the full playlist. Okay, and here we got smart with options in crazy times. Okay, so we covered a very specific approach here with options, which I would like to give a try today with Microsoft. Okay, because again, Microsoft is a company that fundamentally speaking is very strong. Certainly, the more the viruses are hurting the world, the more technology will become important for us, and Microsoft is a company likely going to profit from that, and therefore, as a portion of your portfolio as a long-time investor, you may say, you know what, I would not mind to allocate X amount of capital into Microsoft and owning the shares. So I own for a long-term thing. I own a stock that on top of that pays dividends, etc., etc. So maybe that could be a way to approach it too, given the current situation, crazy times, right? And the stock we are dealing with, which is very strong fundamentally and is a technology-based stock and everything I just said. Okay, so I'm going to give you two choices on how to approach trading Microsoft in today's session. So let's begin with choice number one, which is to do our normal trade. Okay, so our normal trade would consist of, okay, our normal trade would consist of buying a call. Okay, we're gonna buy a call on Microsoft. Okay, we are not gonna do a spread. It would be ideal, but again, because we are in a situation where that stock may start making all times high, like we had multiple times last year, right? And we took advantage of that greatly in the channel. So the idea is get into a long call. Don't set a target. Just follow price. Trail stop using new UFOs that form, and if there is a change of climate, then get out. Okay, and in order to capitalize on that kind of a movement, okay, especially if there is an all-time high type of breakout, normally that is very violent if it happens. If not, it's a complete fake out. And if it's a complete fake out, the most you can lose is what you pay for the call. We know that. So the idea is don't cap your profitability with a spread. Instead, use a long call by itself. This is how we have been dealing with this during the last year. Okay, so what I'm going to do is option number one. Okay, I'm not going to set any target. I'm just going to define my entry, which is 179.19. I'm going to have to pick an expiration date. To pick that expiration date, I'm going to have to consult on the earning date. And today, after what just happened with Baidu, and thanks for that, Ruben. I love the teamwork. So after what just happened with Baidu, I'm quite skeptical about the reliability of the earning dates because, of course, given the coronavirus, many dates may be changing. So 16th of July is the expected date for the earnings. Okay, please go ahead, Ruben, if you don't mind, to double check as well on your end to see what Tastyworks suggests. I will also double check with Yahoo Finance, which is also a pretty reliable source of information, even though earlier it was not the same by one day. And here it also says July 16. So in this case, I think it's going to be the right information July 16 is probably going to be the right one. Okay, so what do we have? July 16 as well, per Yahoo, Leland. Very good. So we'll wait as well to hear from Ruben checking on his platform. Okay, but anyway, so in the meantime, let's take a look at July something, and the nearest to July something is July 17. So this would be the expiration date for us to use to plan a trade on Microsoft. Okay, and I'm just gonna pick a call here, and I'm just gonna right click to analyze and buy a single call. Okay, analyze and buy a single call, which I now have here. And again, I'm not saying that we're going to use the 185. I need to look deeper into this to understand if that's going to be the one or not. Okay. Okay. Second here. So not sure about that one. It doesn't say. Okay. So you see, in the end, lesson to be learned today: always have a backup plan. Okay. Lesson to be learned today: always have a backup plan, because next thing you know, it may or it may not say. A platform, a source of information that works well all the time or most of the time doesn't mean it's going to work well 100% of the time. Okay, so always have a backup plan, and I think that the backup plan is TradingView and Yahoo Finance if you want to use free sources of information. If you have any broker or any additional paid source, that's ideal too. Okay. So now we have the 185 call. If you were to utilize the 185 call, this at the entry price, okay, at the entry price based on the price of Microsoft, okay, this which is 179.18, this option will provide 43 delta, and this is not our rule. Our rule is that we want delta to be around 30. So unfortunately, Microsoft got $5 strike price increments in that expiration date. So if I move to 190, I got 35. If I go to 200, probably it's going to be under. If I go to 195, it's going to be under 35. Is 27. Okay, so then I guess that the compromise here will be to use 190. Ideally, you would have 192, something like that, but it doesn't exist. Okay, so we're gonna go for 190. That will be the trade to be taken. And also, you can see here that if you buy that call, basically you're gonna pay $500 over dollars per call. And remember, that amount of money to be paid for the call is basically your risk. So if you were to buy that call and it cost you, let's say, $550, and then Microsoft goes to zero. So how much is the most you can lose? $550 per call. So if you buy one, your risk is $550. If you buy two, your risk is double, which is $1,100, and so on. Okay, so keep that in mind, because this value sets your risk. So option number one in this trade: buy the 190 call when Microsoft reaches 117.19, and then ride it on the way up and see how far it goes. Trail stop based on new UFOs that form, and if there is a change of climate, get out. Thank you, market, and you are done with the trade. Okay, that's the idea. So I'm just gonna place this order. Okay, I think I gave you time enough to take a screenshot of this. If just in case, I'm just gonna wait a little extra. This is the entry price. Okay, and we are dealing with the Microsoft July expiration 190 call. So this is the important data on the screen. So I'll wait 5 more seconds and I'll place the order, and then we'll talk about the other approach, which is the approach for the crazy times. Okay, the approach for the crazy times. Good habit, Ruben. Good habit to always check in 2 different places. Very good. Well done, my friend. So trade. Okay, I'm just gonna place a market order here. Okay, but of course, it's not going to be good till cancel. It's going to be day only, because this is to be reviewed every day, because the moving average, the EMA, will change every day, and we want it to line up with a UFO. And then activation rule. Okay, that's going to be based on the price of Microsoft. Okay, so if Microsoft is less than or equal to 179.19, okay, so then with that condition, that's an activation rule. Another way to think of activation rule is condition. Okay, this activation rule will give permission to the order to enter the market. Okay, so if that condition is not met, even though we place the order does not go in the market. It stays in the TradeStation servers. Okay, the activation rule will send the order to the market. Another way to say that is the order will be activated based on such condition. So place order, we can now confirm the whole thing. We are buying the 190 call that expires on 17th of July. If Microsoft drops to 179.19, yes, 1, 2, 3, click, and the order is now in the system. So if I look at the Manage tab, notice how my Microsoft trade is waiting to get filled, is being received, and is there waiting. Okay, waiting for Microsoft to fall. Okay, we need Microsoft to fall, and when it gets there, the order will get filled, and then hopefully it goes up. Okay, and if not, the most you can lose is 550 per call. Okay, based on the data we have seen as we plan the trade. So plan number one, buying a call on Microsoft, attempting to take advantage of a new potential all-time high in that particular stock. Option number two on Microsoft is to plan not on a longer term trade, but to plan on a long-term investment. And a long-term investment means that you would be happy to collect shares of Microsoft and be an owner of Microsoft shares, be a shareholder. Okay? So you would be okay not utilizing options, but instead own the shares. Now, for you to own the shares, you can go ahead and buy the shares, and that's it. But this is how, the uneducated or less educated traders in the world would do. Okay, and so again, I'm just thinking of my neighbor, for example. He doesn't trade, he doesn't know how to trade. So if he ever thinks of buying a stock, he will probably think about, do I know the company? Yes or no? Okay, let's buy. What's the price? Oh, whatever price I buy, because I like the stock. So that's how people think. I am absolutely not thinking like that, and it's probably not even needed for me to phrase that. It's obvious that I'm not thinking like that, correct? The way I'm thinking is, for me to buy the stock, I want the stock to be put to me, and I want to get paid to buy the stock. Okay, so how do we do that? And by the way, this is a crash course that explains at the speed of the light what I have explained in that video on YouTube. Go ahead and take a look if you haven't. Okay, so how am I going to deal with this? Well, here's what I'm going to do. Okay, and by the way, I'm going to explain it, and then we'll see if it's possible, because one of the things that can happen with these trades is that it may not be possible. And if it's not possible, then forget about it. Okay, but what I want to do is, I want to be looking at prices where to buy. Let's say I want to buy at 155. So then I would sell the 155 put. Okay, because if I sell the 155 put, okay, for you options traders out there, you know that by selling an option, you acquire an obligation. And because it's a put, the one you sold, the obligation you just acquired is to purchase the stock at 155, which is way better than 183, which is the current price. Now, by selling the put, you get paid. That's good. But what's the problem of being paid? Well, the problem of being paid is that if the stock falls to 155 and keeps falling all the way to 0 or all the way to 100, the stock is put to you at 155 and you are in pain big time because the stock kept falling. And these are crazy times. So I don't want to have a hopeful approach to trading and sell a naked put or a cash secure put, hoping for the best because it's a very good company and that makes me feel good and sleep well at night, because there is a lot of hope in that statement. Instead of hoping, what I want to do is to do something like that. I want to buy the 150 below, because if I buy a put below the one I sold, I sell the 155 and buy the 150, basically the distance between 55 and 50, which is 5, is the most I can lose, which is $500. So if I do that and the stock drops to 155 or below, it will get put to me. But the beauty is that the most I can lose is $5. So now I am not hoping for the best if the stock keeps falling and falling and falling. I know I have set my pain limit at $5. Okay, of course I will get paid less for that because I need to pay money to buy the 150, but it's still a net credit. Okay, it's actually called a credit spread. We do those all the time when we do neutral trades, isn't it? The only difference is that when I do neutral trades, I'm shooting to collect premium and keep the premium. In this case, I'm not going to do that. What I'm going to do is, in one hand, I am willing to buy the stock if the stocks fall to 155 and buy shares and be a stock holder, knowing that the most I can lose is limited by the 150 put I got below. So basically, I buy a stock with an insurance built in, which is nice. But the other thing that could happen, especially if the stocks makes all times high, is that it comes to this UFO, which is what we are planning to do with the long call, and from there it's gonna go up and potentially make all times highs. So, well, if it does that, I'm gonna make a little bit of premium, but I will miss on the whole move. So, what is another approach to this, which is what I explained in that YouTube video, which again I'm summarizing it so you guys can follow this application. Well, another thing I could do is, instead of doing this once, I could do it twice. So I'm going to collect double the premium. And I mean, the premium I'm going to collect is not that great because I'm buying the 150 against the 155. But because I do it twice, then it's going to be a decent amount of premium received. And what am I going to do with this? I'm going to invest that premium to buy a call. Okay, I'm going to buy a call. And basically, I'm getting this call for free because this call is paid thanks to the premium collected below. Okay. Now, of course, this is not a risk-free trade because now if the stocks falls, gets to this point, and you get put stock twice, and then it keeps falling, falling, falling. Okay, yeah, I got my insurance, but I'm gonna lose the difference between those two strikes, which is $5, twice. So this trade carries $1,000 of risk if I was to do this trade. So it's not free of risk. I do have $1,000 of risk. But if the stock goes up, I profit, and basically the cost of the call is free. And if the stock drops, it may get put to me at the price I want it. And if it goes back up, I'm in business. And if it goes down, then the most I can lose is 1,000, which is way less than buying the stock at the price at which my neighbor would buy the stock, which is 183. And if the stock drops from 183 all the way to 150, my neighbor is in pain by $30, where I am in pain by 5. So there is a very, very massive big difference. Okay, it's a pretty smart approach, and I wanted to re-summarize it at the speed of the light, even though today is not a lesson day. But if I don't, most of you will not be able to follow. So I had to. Okay. Again, if you appreciate this type of approach, you can go ahead and watch the YouTube video where I explain that way better. Okay. So now these trades are difficult to put in place. So maybe what's going to happen now is that I'm going to look at the options premium, and next thing you know, I'm not going to be able to make it work. Well, if that's the case, that's what it is. Okay. But if I could make it work, then those trades are pretty nice. Okay. So I'm looking at the whole option chain here, and here instead of using July, I would like to use expiration dates, that pay me the most as possible. And unfortunately, Microsoft is such a stable company that almost every expiration date is around 30. Almost everything is like 30. So really, to be honest, it doesn't matter too much on which expiration date is gonna work or not. Okay, so. Yeah, it doesn't matter too much, to be honest. Okay, so let me try to look at 19 of June, and the reason why is because it's a monthly expiration date, and monthlies normally got better liquidity, more interest. It has 30% instead of 20 something. So let's begin looking at June 19 to see if we could put together a trade on that particular stock. Okay, and here are the strikes available. You know what? It does look like we may be able to have a trade. Okay, so let's take a look at this, and let's load the chart. Okay, and what I'm going to do here is I'm going to look at the weekly time frame on Microsoft. So what's the climate on the weekly time frame? 4 out of 9. Okay, 4 out of 9. The average is around 170. Okay, so utilizing something around the 170, which is right there, we have a UFO actually. So that would be, the way to go. So earlier when I was pointing at 155, really was just an example. But it seems to me that pointing at the 170 could be a valid approach to the trade, because 170 is a place where we have UFOs. And on top of that, on the weekly time frame, we have a defined climate, which is likely going to last at least another 6 weeks. And on top of that, we got the EMA, which, as we know, could be quite powerful as well, combined with the UFOs. So 170, I would say, is probably the price point that I'll be interested in utilizing. Okay, so now let me do a few things here. So I'm gonna right click, okay, and first, just to explain this one step at a time, I'm gonna sell a single. And so I'm gonna get rid of the call. I'm gonna sell a single, okay. And if I sell a single, is the 170 puts, okay, and together with that one, so this one is paying me 350. With that one, and I also want to buy an option below. It goes $5 at a time, so I guess I don't have too many choices. I will want to analyze and buy a single, okay, which is the 165. So I got sell the 170, buy the 165, okay. So this is gonna pay you 350. This will have you pay 250. So you're gonna make like more or less $1, okay. And if I do this twice, okay, if I do this times two, okay, so basically I'm gonna have like $2 I could go ahead and turn around and use to buy a call, and therefore I would be able to buy the 200 call, which only costs 150. Okay, so I could do a trade like that. Okay, I could do a trade like that. Now, to be much more precise on this, okay, what I'm gonna do is I'm gonna drag this option on top of this one, so I can delete that line, and that is now the 170 and the 165 are together, and it shows as a vertical spread, isn't it? And by the way, I said I'm going to use two. Okay, so two. So basically, it means it's going to be 2 times 96. Okay, that's going to be the premium collected. Okay, 2 times 96. I said 2 times $1. Well, it's 96. Okay, so now if on top of that I go ahead and I buy the 200 call, so I'm going to right click to analyze and buy a single call. I was dragging the wrong place, silly me. So here's the call, okay? So 200 call, it would cost you 156, okay? You get twice 94 cents, that's close to $2. You pay 156, that's gonna be a net credit, okay? Notice the difference. These two are 2, so the puts are 2, where the call is 1, okay? The call is 1. But really, the way I like to do this is I would like to drag this here, okay? I would like to drag this here. So now I got it all together, okay? And here we go. Let me make it very visual, like it would show on the chart, okay? So you have on the chart from top to bottom, on the top, you have the 200 call. Below, you have the 170 put that you sold 2 of them. So you have the obligation to buy Microsoft at 170 if Microsoft drops to 170, which is a happy decision, isn't it? Why? Because Microsoft has a green UFO at 170, coinciding with the EMA on the left on the weekly time frame, together with a proper climate. So all of this is good. And as a protection, we got the 165 put below. 165 is below 170. So I organize this vertically speaking from top to bottom, if you wish. So it's easier to understand on your end. And again, I want to re-emphasize one more time that the put side is 2 units, where the call side is 1 unit only. So if you do this trade, what happens? Well, if you do this trade, you would get paid 30 cents. You will get paid 30 cents if you do this trade. Okay, so actually, you do this trade is not for free. You do this trade for a credit. And this trade would give you a delta of 25. In a perfect world, we get 30s. But at the same time, this is not a purely directional trade like what we normally do. This is a smart options play in crazy times. Okay, so in other words, this is a different approach. And again, behind the scenes, I want to repeat myself one more time because it's critical for you to keep in mind forever, which is this trade. The only reason to do this trade is because I don't mind to get put to me Microsoft shares. If you don't want to get put to you Microsoft shares, don't do this trade. By the way, if I get put 200 shares of Microsoft at 170, that means I need to have at least $34,000 available of buying power in my account to be a buyer of Microsoft at this price. And keep all of this in mind, so there is no margin calls or any problems with your brokers because of lack of capital. Okay, so again, this is an investor trade. This is not a active trader type of opportunity. This is a long-term investor type of trade. Okay, assuming that you want to own the shares of Microsoft, but if it doesn't fall and goes up, you profit at a rate of 25, 26, which is almost like what you would profit if you are an active trader. Okay, the only difference is that you are willing to take ownership of shares. That's the big difference. Okay, cool. So anyway, so this trade certainly looks valid to me, and this is a trade that could be executed right now. There is no need for waiting time. But again, when I do these trades, really, I'm not looking for credit. I'm looking for the greatest level of safety as possible. So one thing I would like to try is what happens if I move down to the 160 and the 165. So what if I move everything down $5? Well, if I move everything down $5, unfortunately, the trade doesn't have a negative sign in front. So the trade is not a credit any longer. The trade is now a debit, and I will need to pay $18 to do this trade. Okay, so I don't want to do that. So I'm going to go back to my prior setup, which is good enough. But again, sometimes you do this type of adjustment, and it still gives you the opportunity to do the trade for free, and for free or for a credit. And in this sense, you just created an additional buffer of protection, because now you could afford Microsoft to drop by another $5, and it doesn't bother you. Okay, it doesn't bother you. I mean, behind the scenes, we just said that you want to be a stockholder, you want to be an owner of shares of Microsoft, but at the same time, the lower the price at which you own the shares, the better, isn't it? So 165 would be better than 170. So I tried, but it didn't work. Okay. And by the way, I was doing 165 too, because earlier I saw there was a UFO there at 165. So I'm thinking, if the 165 work, it's amazing. Okay. It will not line up with the EMA. But again, I'm thinking long-term investing, I'm thinking dividends, I'm thinking all sorts of things. So hey, if it goes up, I profit with a call. If it goes down, I get the shares put to me at the lowest price possible. Okay, so this is the whole thinking process I had behind the scenes, and I'm just sharing with you. I'm phrasing my thoughts so you guys can replicate these things on your own when you're looking for opportunities yourself. Okay, so I'm just gonna go ahead and place the order. This is an opportunity to execute now. If you are with me on the whole rationale I explained, keeping in mind this trade got $1,000 of risk per contract. Okay, so this is a trade to do now. I'm just gonna go market with it. Okay, so I'm just gonna do it. 1, 2, 3, place order. 1, 2, 3, yes or no. 1, 2, 3, yes. Here we go. So the order is in. Order is received. And putting on the side that simulated accounts sometimes react quickly or not. So I should get filled on this trade more or less quickly, even though it's looking like TradeStation is a little bit of thinking. But yes, I can see my three trades came in. So I am in a trade here with Microsoft. The current P&L of Microsoft, it's negative $13, which is the spread I suffered by entering the trade because I went market price. If you guys do this trade yourself, make sure you don't use market price. Of course, as always, use a limit order and shave a little bit of the spread. Anyway, my friends, we are in. The trade is in. I'm just gonna sort this so it's more visual, understandable. So we'll do it like that. Like this. And then this is the 165. So I'll just do it the same way I had it on the simulation earlier. So that way, when we review this trade together, you guys can see exactly what's going on and everything else. Okay, here we go. So we have it right there. Microsoft, long one call, short two puts, long two puts. Currently negative minus 17 given the spread, and maybe Microsoft going down just by a little bit. But again, I don't mind. And notice that I entered this trade in the middle of nowhere with no waiting time. And the reason behind that is because I don't want to miss a breakout making all times high, and I want to hold shares of Microsoft as a long-term investor, which is not what we do when we trade actively. Okay, when we trade actively, we don't want to own shares. We want to speculate on the movement using derivatives, in this case options. Here, I changed my hat to be an investor. I know I'm repeating myself, but it's because it's very different compared to what I normally do. And I want to make sure that first you understand and you follow what I'm doing. Second, make sure everybody goes ahead and watches that YouTube video I pointed at so you fully understand this approach. Okay? Cool. Let me see. I always check into different places. Very good, Ruben. And by the way, any final question? This is the time, guys, because the session is over. So we're gonna conclude the session. So any question, or if you just want to say thank you or goodbye, I will also appreciate that. But this is the time for the final questions, guys. Okay, Ruben, if you get put the shares, do you do a color? Not as an investor. Because again, if you get this stock is because you believe in the fundamentals, you want to receive dividend payments. So as an investor, you would just want to have shares on your portfolio with a limited percentage of your capital, which in this case is 34,000. If that is not the case, or that is too large for an account, then don't do the trade. Okay, don't try to save the trade with a collar, because technically doing a collar converts the trade. A collar is exactly the same as a bull call spread. It's the same thing, same risk profile. So is it a smart approach? It depends. So if you own Microsoft and you've been doing cover calls and you collected all that premium and now earnings are about to happen and you are concerned Microsoft is going to crash and you want to color it to survive the risk of earnings, I would say it could make sense. It could be good techniques as an investor to do things like that. But just doing it out of protecting the trade, hoping for the best, well, let's face it, if Microsoft drops to 170 and it keeps going lower, it's probably because the climate is changing. So as an active trader, you will want to get out. As a long-term investor, you may want to stay because you get paid dividends and Microsoft may come back 1 year later, 6 months later. It doesn't matter. In the meantime, you are collecting dividends. Again, this is something that you do with a small portion of your capital as a long-term investor, where it's very unique, where you are now opening the door to, I want to own shares of Microsoft. I want to be a shareholder. So timing is not critical, which is a totally different mindset. Totally different mindset. And if that is not your mindset or your need, don't take this trade. I'm just giving you choices, but make sure you understand. I'll say one last time that for you to take this trade, you do need to have this mindset. Do not improvise. It's very simple, very easy, and it's sometimes unconscious. We trick ourselves. So it's like, okay, well, yeah, it's no way Microsoft is going to fall that low. It's such a good company. Let's do it. And then it does, and then you find yourself put the shares, and you're like, oh, I didn't want to be put the shares. Well, if you didn't want to be put the shares, why did you take this trade in the first place? Where I have stated very, very clearly that you don't do this trade unless you want to be put the shares. So I'm not saying this is your Ruben, okay? I 100% understand where you're coming from. Your question is very good and certainly 100% related to the topic. So very good job clarifying this point with your question, but I want to re-emphasize for everybody so it's clear 100% that you don't do this trade unless you want the shares to be put to you with an investor mindset, where the timing is not critical compared to an active trader, where it's all about timing. What a different game to play, isn't it? Totally different story. Good. I should close the trade before expiration if I don't want to own it, right? It depends. If the stock has, first, if you don't want to own it, don't do the trade. Okay? If you change your mind, if you own it, and now let's say for 2 quarters in a row, earnings have not been good or something's going on in the world, and you're like, oh, you know what? I've been owning Microsoft for 9 months, and you know what? I don't want to own it any longer, and earnings are approaching. So option number 1, close the trade, done. Option number 2, color it sell a call, buy a put, sorry, sell a call and buy a put below, uh, because that will protect risk in case you have a massive gap against earnings. If you want to give the stock a second chance after Microsoft already been moving in your favor 9 months in this example, okay? So again, you will need to have a plan for that. We never talk about this in the sessions because this is long-term investing. In the session, we do longer-term trading, which is not investing, is different. So apply common sense, make rules around that. But keep in mind what I just said, and you may want to watch it and listen to it again because it's, again, a complete different mindset. Okay? Very good, everybody. My friends, loving the time here in the channel with you guys, but it's time to conclude the session. I will see you next time. Take care and stay safe, and for sure, follow your rules, follow the plan, keep up the good work, keep sending those emails, and of course, and soon we'll have a sharpening sessions, guys. Send emails for the session. Be ready for the session with questions so we can take full advantage of it. Okay? Take care, everybody. See you soon. Bye-bye.